Peter, you've talked of 4 different risks which are inherent in the sale of a swap to an SME. The second risk you refer to is interest rate risk. What is interest rate risk?
Interest rate risk is the risk to your cash flow due to interest rates going the wrong way. That means rising interest rates if you have a variable rate loan, or falling interest rates if you have a fixed rate loan. In the banking world, variable rates are regarded as safe and fixed rates are regarded as risky. This can easily be established by looking at how a bank would value a new swap it was thinking of selling. It would value it in 2 parts. First, the value of all the fixed rate payments it expected to receive, and second, the value of all the variable rate payments it expected to make. In the second case, the value would generally be constant.
Can you explain to me how the bank would price a contract?
To understand interest rate risks, I'm going to start with a forward interest rate curve, taken from a Bloomberg on the 1st of October 2007. I'm going to pretend I'm a bank and show you how you price a swap. These interest rates shown by the green line, banks have been accused of knowing that interest rates would fall. This isn't quite true, but they had the next best thing. As they could insure those rates in the swaps market, they knew that their interest rates wouldn't fall once they had done that.
We know that no one knows the future, but you're saying that the banks could fix their own interest rate at future points in time.
Yes, and they did it to make sure they made a profit based on client risk.
What if interest rates fell more than the forward curve indicated?
Then the client would take all the hit. It was the bank that was hedged against falling rates. The client was intentionally exposed by the derivative.
Even today, most of the SMEs within bully banks only understand the initial costs of the product.
That's how the accountants looked at them, cash flow only. To keep the initial costs down, the bank pushed all the risk towards the end of the contract in order to make the contract easier to sell.
So it's like a vicious circle.
Yes, and the SMEs were forced more and more into the hands of the banks.
In reality, it's the opposite of insurance.
Yes. Instead of paying a premium to avoid future risk effects, the bank slips you a contract that seems innocuous, but is designed to expose you to risk for money that they were paid. The cash flows are expected to get worse and worse. That's a bear market.
Peter, the $64,000 question for every SME with borrowings is, should I go for borrowing at fixed rates or borrowing at floating rates?
The complete answer is that what you want is matching. If your assets give you absolutely certain rents, fixed rates might be attractive. But if your business follows the economic cycle, variable rates are where your thinking should start. I personally don't like fixes longer than, say, 2 years.
Why?
3 reasons. First, most SMEs have fixed outgoings. Staff costs, rent, council tax, etc. Not exactly fixed, but quite stable and predictable. So why take on another fixed outgo? Second, government policy is to move base rate in order to help out SMEs in a squeeze. So my view is, start with floating rates and keep some rainy day cash. Third, banks themselves see fixed rates as risky and variable rates as hedged. So does the finance world. Why not follow the experts?
That's very good advice, Peter. Many thanks.